Welcome to this week's Crypto Roundup. We begin this week with a sweeping policy shift from Washington. The White House has released a 168-page crypto policy report offering sweeping recommendations to shape the future of digital asset regulation in the United States. Compiled by President Trump's Working Group on Digital Asset Markets, the document proposes reforms spanning tax policy, regulatory jurisdiction, and digital asset custody. The report urges the SEC and CFTC to collaborate on clarifying rules for custody, trading, and record-keeping of cryptocurrencies. It also recommends giving the CFTC authority to oversee spot markets for non-security digital assets while advocating self-custody rights for individuals. On taxation, the group backs a crypto asset reporting framework that would require U.S. residents to report foreign-held digital asset sales to the IRS. The Treasury and IRS are also encouraged to issue new guidance covering wrapping transactions and to minimize crypto receipts. There is a lot to get done, but this is a fantastic roadmap on what's next for true regulatory clarity for crypto in the U.S., wrote crypto lawyer Rebecca Rettig on X. That said, it offered little new information on the U.S. Strategic Crypto Reserve. Just one day later, the SEC followed up with its own initiative to reshape crypto regulation. SEC Chairman Paul Atkins has unveiled Project Crypto, a regulatory initiative aimed at updating securities rules to accommodate on-chain technologies. The project directs SEC staff to modernize guidelines around custody, trading, and digital asset classification. Project Crypto will help ensure that the United States remains the best place in the world to start a business, develop cutting-edge technologies, and participate in capital markets, Atkins said. The initiative includes collaboration with Commissioner Hester Peirce's Crypto Task Force and seeks to implement the President's Working Group recommendations. A key goal is to classify digital assets into categories such as stablecoins, digital collectibles, and digital commodities. Atkins also highlighted future rule proposals for tokenized securities and decentralized finance platforms, stating, "Decentralized finance and other on-chain systems will be part of our securities markets, not drowned out by unnecessary regulation." Meanwhile, on Capitol Hill, a new proposal is looking to bring crypto into the housing market. Senator Cynthia Lummis has introduced the 21st Century Mortgage Act, a bill that would allow long-held crypto assets to be considered in mortgage underwriting. The proposal aims to support borrowers, especially younger Americans, by including certain digital holdings in their financial profiles without requiring conversion to U.S. dollars. The legislation codifies a directive already underway from Federal Housing Finance Agency Director William Poult. In June, Poult instructed Fannie Mae and Freddie Mac to explore incorporating qualified crypto reserves into mortgage risk assessments. Under Lummis's bill, digital assets held in a qualified custodial arrangement for at least 2 years could count as borrower reserves. This legislation embraces an innovative path to wealth building, Lummis said, emphasizing the digital shift among younger homebuyers. And in platform news, Coinbase is widening its horizons in a big way. Coinbase is preparing to roll out a broad expansion of its platform, introducing tokenized stocks, prediction markets, and early-stage token sales to U.S. users in the coming months. The move is part of the company's push to become an everything exchange, integrating both crypto-native and traditional assets into a single on-chain platform. "We're bringing all assets on-chain, stocks, prediction markets, and more," said Max Brandsburg, Coinbase's vice president of product, in a statement to CNBC. The upcoming features will position Coinbase alongside competitors like Kalshi and Polymarket in the prediction markets space and rival global tokenized stock offerings from Robinhood, Gemini, and Kraken. However, Coinbase's new services will be available to U.S. customers first, with plans for international expansion pending regulatory approvals. Turning now to the courtroom, where a high-profile case took a sharp turn. The U.S. Department of Justice has clarified that crypto venture firm Dragonfly is not a target in its criminal investigation into Tornado Cash, reversing earlier suggestions made in court. The update followed a hearing in the trial of Tornado Cash co-founder Roman Storm, where prosecutors had initially indicated that Dragonfly executives could face charges related to their 2020 investment in the privacy-focused crypto mixer. At the time, internal emails between Dragonfly partners Tom Schmidt and Hasib Qureshi and Tornado Cash developers were presented, including discussions about potentially adding KYC features. Schmidt, called as a defense witness, declined to testify by invoking the Fifth Amendment. Following the hearing, Qureshi stated, "The government's comments were aimed at limiting defense testimony." The DOJ has now backtracked, he posted on X, adding that Dragonfly has been cooperating since receiving a subpoena in 2023 and intends to defend itself if necessary. Elsewhere in regulatory news, ETF markets just received a long-awaited upgrade. The U.S. Securities and Exchange Commission has authorized in-kind redemptions for all spot Bitcoin and Ethereum exchange-traded funds, aligning crypto ETFs with traditional commodity products. Previously restricted to cash-only structures, ETF issuers can now redeem and create shares directly with Bitcoin or Ether. This shift is expected to reduce trading friction, tighten spreads, and improve tax efficiency. Authorized participants, typically large financial institutions, will be able to exchange ETF shares for the underlying crypto assets rather than fiat, a model long requested by asset managers. The move is seen as a milestone in ETF market infrastructure, reflecting growing regulatory acceptance. In a parallel development, the SEC acknowledged a NASDAQ proposal to enable staking for BlackRock's iShares Ethereum Trust. If approved, the ETF could generate yield by staking Ether while distributing rewards to shareholders. The application now enters a regulatory review window that could last up to 90 days. In related news, a new plan from Cboe could fast-track crypto ETFs like Solana and XRP by bypassing individual SEC approvals, potentially opening the door to multiple listings as early as October. And speaking of major institutions, one of the biggest U.S. banks is stepping deeper into crypto. JPMorgan Chase and Coinbase have announced a strategic partnership that will enable Chase credit card holders to purchase cryptocurrency directly through Coinbase, beginning in fall 2025. The collaboration marks a major step in integrating digital assets into traditional banking services. Starting in 2026, Chase customers will also be able to redeem their ultimate rewards points for USDC, a dollar-pegged stablecoin issued by Circle. This reward redemption will take place on Base, Coinbase's Ethereum Layer 2 network, and represents the first time a major credit card program will allow points to convert into crypto. The agreement includes additional features, such as the ability for users to directly link Chase bank accounts to Coinbase, streamlining fiat-to-crypto transactions. Coinbase noted that credit card purchases may be treated as cash advances under existing terms. Staying on the topic of stablecoins, 3 different developments this week show how far their adoption has come. Stablecoins are taking center stage in the latest wave of crypto innovation, with major firms and projects pushing forward new use cases and infrastructure. PayPal has launched Pay with Crypto, a service enabling U.S. merchants to accept over 100 digital assets at checkout. Customers pay in crypto while merchants receive U.S. dollars or PayPal's native stablecoin, PYUSD. The platform touts potential savings of up to 90% on cross-border transactions compared to traditional credit cards. Merchants can also hold PYUSD and earn yield on balances. Meanwhile, Interactive Brokers is considering launching its own stablecoin to offer 24/7 account funding and faster crypto transfers. The $110 billion brokerage is also evaluating broader integration of third-party stablecoins to enhance its digital asset services. Adding to the momentum, Bitcoin sidechain Plasma concluded a public sale of its token XPL, raising $373 million. The project claims it will launch with $1 billion in stablecoin total value locked, setting a record for mainnet adoption speed. Now to a high-profile legal reversal that could set a precedent in the NFT space. A U.S. appeals court has overturned the conviction of former OpenSea product manager Nathaniel Chastain, who was previously found guilty of wire fraud and money laundering in connection with NFT trades made using confidential company information. Chastain was originally charged in 2022 for allegedly purchasing NFTs ahead of their promotion on OpenSea's homepage, then reselling them at profits of 2 to 5 times the purchase price. He was convicted in 2023 and sentenced to 3 months in prison. However, the Second Circuit Court ruled Thursday that the jury was incorrectly instructed. The court agreed with Chastain's argument that using confidential business information does not constitute property theft unless it involves a recognized property interest. We cannot say that the jury would have reached the same verdict if it had been properly instructed, the judges wrote. The ruling also referenced Chastain's claim that OpenSea's co-founder engaged in similar conduct. Now let's talk about a shift in launchpad dominance, which highlights a changing dynamic. Coinbase's Layer 2 network base has overtaken Solana in daily token launches, marking a shift in crypto activity not seen since early 2023. The spike is largely driven by Zora, a social media protocol that automatically mints a token for every user post. On July 27th, Zora set a record with over 54,000 tokens launched in a single day, significantly outpacing Solana platforms, Pump Fun, and Let's Bonk combined. According to analytics firm CLaunch, DEX volume of Zora coins has also spiked, as both creators and referrers earn a share of trading fees. Despite Base's rising numbers, Solana still holds a much larger overall market cap in Launchpad tokens, with $5.9 billion compared to Base's $422 million. It's a different model, noted Helios Labs CEO Mert Mumtaz, who emphasized that Zora's token creation is tied to social content rather than traditional meme coin speculation. And before we go, one network faced an unexpected test this week. Polygon experienced a temporary disruption on Wednesday when its Heimdall consensus layer halted for roughly 1 hour due to a validator unexpectedly exiting the network. The issue followed a recent upgrade to Heimdall 5.2, described by Polygon as its most technically complex hard fork since 2020. While Heimdall handles coordination among validators and communicates with Ethereum, the outage did not affect the Bohr layer, which continued to process transactions normally. This meant that core user activity, such as sending and receiving tokens, remained uninterrupted. Some developers and users, however, faced difficulties accessing services, with RPC endpoints and block explorers like Polygon Scan showing no new blocks during the disruption. RPCs serve as the connection points that wallets and applications use to interact with the network. Polygon stated that the POS chain has remained live, but acknowledged degraded performance during the outage. A patch was issued, and most RPC providers were restored within hours. Unchained is produced by me, Laura Shin, with help from Matt Pilchard, Juan Uranovich, Pam Majumdar, and Marco Correa. Thanks for listening.